Have you ever wondered how to start investing? Investing. It's a word that can conjure up images of Wall Street, stock tickers, and maybe even a little anxiety. But at its heart, investing is about one thing: making your money work for you. It's about taking that hard-earned cash and letting it grow over time. But why is investing so important? Well, consider this. If you simply let your money sit in a regular savings account, it's actually losing value over time due to inflation. On the other hand, when you invest, you're giving your money the chance to grow and potentially outpace inflation. In other words, investing is a key strategy to build wealth and secure your financial future. Now you might be thinking, sounds great, but isn't investing just for the wealthy or the financial whizzes? The answer is a resounding no. Anyone can invest, and you don't need to be a Wall Street guru or have a mountain of cash to start. But before you jump in, it's crucial to understand that investing is not a guaranteed way to make money. There's always a level of risk involved. When you invest, you're essentially buying a piece of a company or a commodity with the hope that its value will increase over time. But sometimes the value can decrease. That's why it's called the stock market and not the stock sure thing. However, the potential rewards can be significant. Over the long term, investing has been shown to be one of the most effective ways to grow your money. And with the right strategies and a bit of patience, you can navigate the ups and downs of the market and come out ahead. So, are you ready to give your money a job and let it work for you? Excellent! Because now that we've laid the groundwork, let's dive into how you can start investing. Before you start investing, you need to understand your financial goals and risk tolerance. Imagine setting off on a journey with no destination in mind. It's likely you'll end up somewhere you didn't intend. The same principle applies to investing. Having clear financial goals gives your investment journey direction and purpose. Whether it's saving for retirement, a new home, or your child's education, each goal requires a different investment strategy. Now let's talk about risk tolerance. This is essentially how much financial risk you're comfortable with. Just like how some people are thrill seekers, loving skydiving or bungee jumping, others prefer a quiet read at home. Similarly, some investors are comfortable taking on more risk for potentially higher returns, while others prefer safer, more predictable investments. Understanding your own risk tolerance is crucial as it directly affects your investment decisions. Once you understand your financial goals and risk tolerance, you're ready to start creating your investment plan. Creating an investment plan is a crucial step in the investing process. An investment plan is your financial roadmap. It guides you to your financial goals, helping you navigate through the twists and turns of the markets. A well-crafted plan can keep you on track even when the economic weather gets a bit stormy. So how do you create one? First things first, you need to decide on an investment strategy. This is essentially your game plan for investing. Are you a risk taker ready to ride the highs and lows of the market for potentially higher returns? Or are you more of a slow and steady wins the race type of investor, preferring more stable, lower risk investments? Your strategy will be unique to you, reflecting your financial goals, your risk tolerance, and your investment timeline. Once you've decided on your strategy, it's time to choose the right investment products. These are the vehicles that will carry you towards your financial goals. Stocks, bonds, mutual funds, exchange-traded funds, real estate. There's a whole world of investment products out there, but don't let that overwhelm you. Not every product will be right for you. It's about finding the ones that align with your strategy, your goals, and your risk tolerance. Remember, investing is not a one-size-fits-all endeavor. Your investment plan should be as unique as you are. It should reflect your financial goals, your risk tolerance, and your investment timeline. It should guide your investment decisions, helping you to stay focused and on track. But it should also be flexible, able to adapt to changes in your life and in the markets. And one more thing. Creating an investment plan isn't a set-it-and-forget-it kind of deal. It's a living document that should be reviewed and updated regularly to ensure it continues to serve your needs and goals. With your investment plan in place, you're ready to start investing. Choosing the right investment products is key to achieving your financial goals. Now, let's dive into the ocean of investment products, where each one has its unique characteristics and potential returns. First stop, stocks. Investing in stocks means buying a piece of ownership in a company. Stocks are attractive because of their high return potential. But remember, with great rewards often come great risks. The value of stocks can fluctuate dramatically, making them a more volatile investment option. Next, we have bonds. When you invest in bonds, you're essentially lending money to a company or government for a fixed period. In return, you receive interest payments at regular intervals. Bonds are generally considered safer than stocks, offering more predictable returns. But the flip side is, their earning potential is typically lower. Then there are mutual funds, a popular choice among many investors. Mutual funds pool money from multiple investors to invest in a diversified portfolio of stocks, bonds, or other assets. They're managed by professional fund managers, which can be a big plus if you don't have the time or expertise to manage your investments. However, they do come with management fees, and the returns are not guaranteed. So how do you choose the right investment products? Well, it all comes back to your financial goals and risk tolerance. If you're aiming for higher returns and willing to take on more risk, stocks might be your game. If you prefer stable returns and can't stomach too much volatility, bonds could be a better fit. And if you're looking for diversification and professional management, you might want to consider mutual funds. Remember, there's no one-size-fits-all when it comes to investing. It's about finding the right mix that aligns with your investment strategy and comfort level. And don't forget, diversification is your friend. Spreading your investments across different types of assets can help reduce risk and smooth out potential returns. Once you've chosen your investment products, you're ready to start investing. So, let's move on to the next step, where we'll explore how to start investing. Now that you've done all the prep work, it's time to start investing. The first step in this journey is to open an investment account. This can be done with a bank, a brokerage firm, or an online platform. Each of these options comes with its own set of advantages and considerations, so it's crucial to do your research and choose the one that best aligns with your needs. Once you have your account set up, you're ready to start buying investment products. Remember, don't rush into buying just any product. Be patient and stick to your investment plan. Consider the various options available to you: stocks, bonds, mutual funds, ETFs, and more. Each of these has its own risk and return profile, so it's important to diversify your portfolio to balance out the risks. Now you might be wondering, I've bought my investments, what's next? Well, investing isn't a set it and forget it game. It's important to regularly monitor your investments. This doesn't mean checking your portfolio every hour. That's a surefire way to stress yourself out. Instead, set a schedule to review your portfolio, maybe once a quarter or biannually. This way, you stay informed without becoming obsessed. Monitoring your investments also allows you to make adjustments as needed. Maybe you notice a certain stock isn't performing as you'd hoped, or perhaps your financial goals have changed. These adjustments are a normal part of the investing process. They're not failures but opportunities to learn and grow. Finally, don't get discouraged if you don't see immediate results. Investing is a long-term game. It's about building wealth over time, not getting rich quick. So be patient, stay disciplined, and keep learning. The journey to financial independence is a marathon, not a sprint. And there you have it. You're now ready to start investing and building your wealth. So, are you ready to start your investment journey? As we wrap up, let's quickly review what we've learned. We started by understanding the importance of identifying your financial goals and risk tolerance. Remember, no two investors are alike, and the key is to find a balance between risk and potential returns that works for you. Next, we discussed creating an investment plan. This involves setting clear, achievable goals, deciding on an investment timeline, and determining the amount you're willing to invest. The plan serves as a roadmap, guiding you through your investment journey. Then we delved into the exciting world of investment products. From stocks and bonds to mutual funds and ETFs, there's a wide variety of options to choose from. Picking the right ones is crucial to building a diversified portfolio that aligns with your investment plan. Finally, we took the first step towards investing. Remember, it's all about starting small and gradually building up. Don't be afraid to take that first step. Remember, investing is a journey, not a destination. Good luck on your investment journey.